You have invested in a mutual fund, but do you actually know how it works? Well, a mutual fund is actually a remotely operated, pooled special purpose vehicle of funds. This special purpose vehicle, also known as a mutual fund scheme, is actually a trust where units are issued to mutual fund investors who participate in this particular mutual fund strategy. Typically, in mutual funds, there are different categories of risk, like a conservative risk or low risk profile, which are usually debt and fixed income products, moderate risk, which are usually solution or hybrid products, and high risk, which is typically all kinds of equity funds. So, what kind of mutual funds do exist in Indian markets? Firstly, of course, the most popular and the most well-known are equity mutual funds. There's also debt mutual funds that invest in government securities and corporate bonds. But there are hybrid mutual funds which allocate to both equity and fixed income, like government bonds and corporate bonds. There is solution-oriented mutual funds, which is a recent phenomenon in mutual fund where it's usually a targeted towards a particular aspect of your objective. So it's a solution to that objective. And then there are other categories like sectoral funds, index funds, and so on. Recently, a few years ago, SEBI in fact also allowed commodity-based futures to be included in mutual fund, but sadly so far none of such products have been launched by any AMC. That said, I think a mutual fund is basically a trust where the unit holder of mutual fund receives unit of that trust. It's a bankruptcy remote vehicle from the management of the company, which means that the pool of money collected in the mutual fund by the distributors and the fund, which eventually flows into the mutual fund, is actually not related to the functioning or the operating cash flow of the sponsor company, in which case is the asset management company. Just to make it an example, let's say there's a mutual fund company called XAMC. They have a management company that sponsors a mutual fund. That sponsored mutual fund is a trust, and the investors in that mutual fund are issued units from the trust. The trust has a trustee board as oversight. They have custodians. They have brokers that interact with that trust in terms of execution of trades, and plethora of other costs. So you can actually look at these costs. For example, how much do the trustees charge? How much do each one of these services cost you as a unit holder when you're invested in this mutual fund, by looking at the financials of that specific mutual fund, not the AMC. And finally, typically you will see that during an NFO or a new fund offering, most of the marketing expenses get attributed to the fund. Now, unless it's a very significantly different product compared to another mutual fund, there's hardly ever any benefit of being part of an NFO. So, if there's a comparable product which has a longer track record and a history in another AMC, given that most of them are equally regulated, you should just focus on the quality of the fund management, the quality of the track record, and the cost, and then you're done. You don't really need to use an NFO to get into a new kind of fund. However, there are certain AMCs that have very specific and very specialized mutual fund launches. Could be closed-ended, could be ones that use hedging. In such cases, when you find such distinct products which are not available in the market and you're interested in such products, you can definitely consider an NFO. But on an average, the answer is do not look at NFOs to begin with. Hope you found this interesting and useful, but do watch for more. I'll come up with more of these kind of videos soon. Thank you.